Interest rates are at all-time lows right now, and you might be considering doing a refinance in your mortgage. While the rates are incredible, I want to make sure that you know the 7 key considerations that you should be thinking about before you start the refinance process. In today's video, I'm just going to quickly introduce these 7 key considerations that you should think about before doing the refinance. Number 1, I want to talk about your credit score. Number 2, I'm going to dig into the refinance costs. Those closing costs are really important. Number 3, I want to talk about home equity. What is it? Why does it matter? Number 4, I want to discuss your debt to income ratio. That's a big one when you're doing a refinance. Number 5, I just want to make sure we break down the rates versus the term. Number 6, private mortgage insurance. Quickly, what is it? How does it impact your refinance? Number 7, I just want to go into what is the break-even point? When does it make sense to do a refinance versus sticking with your original mortgage? I'm going to quickly talk about these topics today, but I am going to put a link down to a blog post that I recently wrote that goes in depth on all these different topics. And of course, if you do have any questions, don't hesitate to reach out. I'm happy to discuss anything that has to do with your financial plan or specifically just the refinance. All right, so let's just do a quick overview of these 7 different considerations. You've started the process, which is great. You've recognized that rates are at all-time lows and you want to lock something in for the rest of your mortgage. But let's make sure that you understand your credit score. Number 1, it makes a really big difference. In today's market, thankfully, the mortgage industry has tightened up their standards from what happened in 2008, 2009 with the housing crisis, and just everything that's going on in the world. Making sure that you have a great credit score is going to help the process and ensure that you get one of those good rates. General rule of thumb, if your credit score is 760 or higher, you should qualify for some of the best rates. Again, every lender is going to be a little bit different, but that's a good target. That's a good number to shoot for. 760 on your credit score. Obviously, if you were really close to that, I don't want to discourage you from applying. You can do things to improve your credit score. That's something that we can talk about or definitely discuss with the lender if this is something that you've already started. So number 1, credit score. Number 2, I want to talk about refinance costs. The closing costs that go into doing a refinance, that's going to make a big impact on the decision of if it makes sense or not. General rule of thumb, again, just kind of keeping things broad, you should expect closing costs to be 2 to 6% of the mortgage amount. Again, it varies at every lender, but just don't forget this. Don't let that get swept under the rug. Make sure you understand how those closing costs work. Getting the best and the lowest interest rate might mean you're going to have to pay higher closing costs. So that's something that you need to take a close look at, talk through it with your lender, and this is going to help us with number 7, break-even point. We're going to discuss that in a little bit. So number 2, what are the refinance costs of doing the refinance? For number 3, I just want to bring up the idea of home equity. When you're doing a refinance in your mortgage, you want to ensure that you have equity in your home. In other words, you want to make sure that the value of your home is higher than the actual mortgage amount. In a perfect situation, you'd have at least 20% equity, or in other words, 80% loan to value is going to be that cap. That way you can get the best rates, you can avoid PMI in most situations, and it just gives you a little bit of wiggle room on the appraisal. So home equity plays a big part into it. If you just bought your home and for whatever reason, maybe it's still close to that same original amount and it hasn't increased in value, this is something you're going to want to look at. But a 20% home equity, that's a good number to shoot for. So for number 3, home equity, make sure you know how much you have. Number 4 is your debt to income ratio. And this is one that you can do a pretty quick calculation, just figuring out what's your income versus what are your debt obligations each month. Besides the mortgage, do you have car payments? Do you have student loans? And some of these things, again, you want to talk with the lender. If your car loan is going to get paid off in just a couple of months, sometimes the lender can remove that from the equation. But it's pretty easy to figure out. You want to have as much income versus debt as possible, but this is going to play a big role. Now, the blog article that I wrote, it goes into detail of what those numbers should look like, but debt to income ratio is something that you want to at least have a general idea of before you start this process. So number 4, debt to income ratio. For number 5, I just want to bring up the fact that the rate versus the term. This is really important to know how this whole distinction works. Now, the term of your mortgage, it could be a 30-year loan or a 20-year loan, or maybe it's a 10-year loan. Ideally, you want to find that number that's going to help you pay it off at an amount that you can afford. But to get the best rate, to get the lowest rate possible, obviously if you're choosing a mortgage with a lower term, you're going to get a better interest rate. But this is something where you can examine the interest rate on a 30-year versus a 20-year. If it's not a big difference, you can get the 30-year mortgage, gives you a little bit more flexibility with your monthly payments each month, and maybe you can pay a little bit on top of that just to get it paid off faster, but it gives you flexibility. If for 1 month you just need to make that minimum payment, then you can do that. So I just quickly want to bring this up, rate versus term, just understand how that ratio impacts the interest rates, how long the term of the mortgage is versus the rate. Doesn't always mean you have to go for that lowest rate to get the lowest term. This is something that you want to make sure fits your budget. So number 5, let's look at the rates versus term. So number 6, I just want to talk about the private mortgage insurance, otherwise known as PMI. Typically, when you buy a home and you put less than 20% down, you do end up paying this PMI. It's just kind of wrapped into your monthly payment. So another reason to refinance is if you've got more than 20% equity in the home because you've been paying it down and the value of the home has been going up, maybe you can do a refinance to get a lower rate and get rid of the PMI. Now, private mortgage insurance, there's different ways to get rid of it and there's different ways to pay it off. So I'm just really speaking in general terms here. Again, the blog article that I wrote goes into a little bit more detail, but make sure that you're aware, this is another reason people are refinancing right now. Besides getting a better rate, you might be able to get that PMI taken up. So private mortgage insurance, that's number 6. Again, if you have any questions, take a look at the article or let me know. Number 7 is the break-even point. This is where we've figured out those refinance costs. We know what the closing costs are going to be. We realize we've got to pay some money up front to get this mortgage at a better rate. So let's figure out, all right, well, if I'm going to get a better interest rate, that means I'm hopefully going to be saving money each month. When does this refinance pay for itself? And, it could take a couple of years. If you're saving a couple $100 per month and the closing costs were a few $1,000s, you can do the math. Again, the article I wrote does a quick little case study of how this works. I encourage you to take a look. But this is what it's all about. The break-even point is why you might want to do a refinance. And hopefully you're going to save interest over the long term. But just a quick rule of thumb, if you're going to be moving in a few months or maybe even a year or two, a refinance might not make sense because you've got to pay all those refinance costs. And if the closing costs are going to outweigh any of the savings that you're going to receive, what's the point? So number 7, figure out that break-even point, and then we can figure out if the refinance makes sense. So there it is, 7 considerations that you should think about before doing a refinance on your mortgage. These are really great things to think about. There's so many different variables that go into doing a refinance. I just wanted to make the point that the interest rate isn't the only thing that you should focus on. Go check out that blog article. There's a lot of great resources in there. My name is Alan Hensley. I'm a wealth advisor here at Merriman Wealth Management in Seattle, Washington. If you have any questions about this or any other financial planning topics, let me know. Put a comment down below. I'll make more videos, or if you want to connect one-on-one, let's do that. Thanks so much, guys. Have a great day.